Welcome back to the Pro Ticker Podcast, everybody. It's Thursday morning, and we are covering major financial magazine headlines.
It's going to be a busy one today.
Oh, yeah. We've got a lot to get through. Interest rate decisions, some pretty wild stock market action, and even JetBlue is making some interesting moves.
Let's jump right in.
Okay, so first up, interest rates. MarketWatch is calling today Super Thursday because we have both the Swiss National Bank and the European Central Bank making their rate decisions. And wow, the S&P just made a huge move, slashing rates by a full 50 basis points.
Yeah, that's double what most analysts were expecting.
Exactly. I mean, for anyone who needs a reminder, 1 basis point is just 0.01%.
Yeah.
So we're talking about a half percentage point decrease.
It's a big deal, and it comes right after Canada surprised everyone yesterday with their own 50 basis point cut, too. It seems like central banks are really hitting the brakes.
Right. So what does it all mean? Well, CNBC says it could be a sign that they're seriously worried about the global economy, trying to prevent a recession.
But Bloomberg also pointed out that it could be more of a preemptive move. They could be seeing inflation cooling down, and they're trying to get ahead of it by stimulating their economies before things slow down too much.
It's kind of like a damned if you do, damned if you don't situation. But how does all of this affect our listeners, the average investor?
Well, rate cuts can have a ripple effect on everything from bond yields to mortgage rates, so it might be a good time to reassess your portfolio and make sure you're positioned for whatever comes next.
Exactly. Now everyone is watching the ECB to see what they do. Most experts seem to think they'll cut rates too. But the big question is by how much? Bloomberg thinks it'll be a smaller cut, like 25 basis points. But what they say about the future will be the real story.
A big cut might mean they're bracing for a rough ride. A smaller cut might mean they're a bit more optimistic.
Right. And we can't forget about the euro either. Rate cuts can weaken currencies, which can affect everything from the cost of imported goods to returns on your foreign investments. So pay attention to how the euro reacts to whatever the ECB decides.
Now, while all that is going on, let's switch gears to the U.S. stock market, which is having a bit of a party right now. The NASDAQ Composite just blew past the 20,000 mark for the first time ever.
Yeah, that is a huge milestone, and MarketWatch says it's largely thanks to tech giants like Alphabet and Meta hitting record highs.
But the big question is, how long can this party last?
Exactly. Well, MarketWatch highlighted this analyst from Stifel named Barry Bannister, who's actually predicting an S&P 500 correction in the second half of 2025.
So he's saying the good times might not last forever.
Right. So is he just being a pessimist, or does he have a point?
Well, he makes some interesting arguments. He thinks the Fed only has a couple more rate cuts up its sleeve and that inflation is stickier than people think. And he also thinks market valuations are getting a little too high. Basically, he's saying things might get messy.
So that's one side of the story. But what about the folks who think this bull market can keep running?
Oh, there are plenty of those folks, too. They point to strong corporate earnings, continued low unemployment, and the potential for even more technological innovation to keep things moving. They're saying this isn't just a bubble, it's a sign of a strong economy.
Okay, so who's right? It's impossible to say for sure. But the takeaway for our listeners is that it's always a good idea to be prepared, maybe rebalance your portfolio, take some profits off the table, and think about what you do if the market does take a dip.
Okay. Now, while we're on the topic of markets, there are some interesting moves happening over in Tokyo Blackstone. That global investment giant just dropped a whopping $2.6 billion on a huge mixed-use complex.
Yeah, the Wall Street Journal said it was their biggest deal ever in Japan. So what's got Blackstone so bullish on Tokyo?
Well, this isn't just any office park. The Wall Street Journal called it a mini city. It's got offices, luxury apartments, hotel restaurants, you name it. It's called Tokyo Garden Terrace, Kyoicho, and it's in a prime location right in the heart of the city.
So they're betting big on Tokyo continuing to be a global hub.
Exactly. And the Wall Street Journal also said that this deal is part of a larger trend. Foreign investors have been pouring money into Japan lately, especially with the yen being relatively weak right now.
So is this a signal that maybe our listeners should consider investing in Japanese real estate? It's definitely worth exploring.
Absolutely. Okay, now let's switch gears to something a bit more relatable. JetBlue just announced a brand new first-class option for domestic flights starting in 2026. And get this, they're calling it Junior Mint?
I saw that CNBC headline, too. What a name for a first-class offering.
Right.
All right.
So what exactly does this new class offer, and how is it different from their existing Mint business class?
Well, CNBC didn't have all the details yet.
Yeah.
But they did say it's part of JetBlue's plan to boost their profits and win back some of those high-paying customers after their attempt to buy Spirit Airlines fell through.
It sounds like they're trying to find a middle ground between their current luxury Mint offering and something a little more affordable that might appeal to a wider range of travelers.
That makes sense. So how do you think this Junior Mint class will affect the rest of the airline industry? Could we see other airlines offering their own more affordable premium options?
It's definitely possible. If this works out for JetBlue, we might see a whole trend of more accessible premium seating on domestic flights. And that could be great news for travelers who want a little extra comfort without paying a fortune.
All right, so we've covered a lot of ground already. Interest rates, stock markets, real estate in Tokyo, and even a new first-class offering from JetBlue. But we're just getting started.
All right, so let's move on to another market that's been pretty interesting lately. Gold CNBC said it hit a one-month high earlier today.
Oh, really?
Yeah, but then it slipped back a bit. Probably some investors taking profits.
That's interesting because usually gold does well when there's talk of rate cuts and market corrections. It's seen as a safe haven. So why hasn't it gone up even more? Especially with the CME's FedWatch tool showing a high chance of a rate cut next week.
Well, CNBC also mentioned that investors might be thinking about other things going on globally, like all the geopolitical tension with that UN resolution on the Israel-Palestine conflict. Uncertainty usually pushes people towards gold. But it seems like they're hesitant this time.
Maybe they're waiting to see what happens before making any big moves.
Could be. Now, speaking of market reactions, did you see what happened with healthcare stocks?
Yeah, CNBC said that shares of companies like United Health Group, Cigna, and CVS Health all dropped yesterday.
It was a pretty big drop. The Wall Street Journal said it was because of this bipartisan bill that's trying to break up those pharmacy benefit managers, the PBMs.
Oh, right. Those PBMs have been in hot water for a while now because of their role in those rising drug prices.
Exactly. So if they get broken up, it could really change their business model, and that's why investors are nervous.
And it's not just that CNBC also mentioned all the public criticism the healthcare sector's been getting after that tragic shooting of the United Health Group Insurance CEO, Brian Thompson. It's a tough time for the industry.
For sure. Okay, let's shift gears again. What do you think about oil prices? They've been all over the place.
Yeah, Bloomberg said they've been stuck in this narrow range, kind of caught between a few different things. Geopolitical risks, worries about demand next year, and of course the whole Trump presidency thing.
Right, and then Bloomberg also reported that OPEC just cut its demand growth forecasts again for the fifth month in a row. This time it was the biggest cut yet to their 2024 world oil demand forecast. Not exactly a good sign.
No, not really. But on a more positive note, CNBC said that China's crude imports went up in November for the first time in 7 months. So maybe demand is picking up from the world's biggest oil importer.
Yeah, that's a good sign. But even with that, Bloomberg said that the International Energy Agency is still predicting a potential oil glut in 2025, even with OPEC plus delaying those output increases.
It's a mixed bag for oil right now. Bloomberg highlighted that geopolitical tensions and potential sanctions on Russian and Iranian oil could push prices up. But then weaker demand, especially from China, could pull them right back down.
It's a tough situation, and those Fed interest rate decisions are going to play a big role, too.
Okay, now for something completely different. SpaceX, their valuation just went through the roof.
Oh, yeah. CNBC said it's now at a crazy $350 billion, just based on their recent secondary share sale.
I know, it's insane. CNBC pointed out that puts them ahead of most major U.S. defense contractors and even some of those giant companies in the S&P 500.
It's pretty amazing. It really shows how much they're dominating the space industry.
They've pretty much got a monopoly on the U.S. satellite launch market. Their Starlink satellite internet business is growing like crazy, and then there's that ambitious Starship program that keeps making progress.
And we can't forget about Elon Musk's connections with the new administration either. It seems like everything is going right for SpaceX.
Absolutely.
Right.
Now, while we're talking about high valuations, we should probably bring things back down to earth a little bit and talk about the U.S. stock market again.
Right.
That NASDAQ hitting 20,000 is exciting, but there are some things to be cautious about.
Right. Well, Bloomberg said that 10-year Treasury yields have been climbing. They're around 4.3% right now. And that could be bad news for those growth stocks that are really sensitive to interest rate changes.
And MarketWatch mentioned concerns about increased U.S. deficit spending under the new administration. They said it could push yields even higher and make those bond vigilantes nervous. The investors who sell off bonds when they think inflation or interest rates are going up.
Right. And MarketWatch also highlighted the potential impact of a strong dollar on the earnings of those big multinational companies. That's something investors need to keep an eye on.
It seems like there's always something to worry about, even when the market is doing well. So what does all of this mean for our listeners?
It means that even with all the positive news, there are still risks involved. You need to stay informed, diversify your portfolio, and be ready for anything.
Very good advice.
Yeah.
Okay, before we move on, let's do a quick check on the U.S. dollar. Bloomberg said it's down slightly, while the euro has actually gotten stronger ahead of that ECB meeting.
That's interesting. It seems like the market is expecting the ECB to be pretty dovish, meaning they're focused on stimulating growth, which could make the euro even stronger.
And speaking of market expectations, Bloomberg said that traders are now almost certain that the Fed will cut rates at their meeting next week. Just a week ago, there was only a 75% chance of a cut.
Wow, so the market is pretty confident about that rate cut. Now let's talk about something a little different. What's going on in the bond market?
Okay, what's happening?
Well, Bloomberg reported that U.S. inflation data isn't having as much of an impact on Treasury yields as it used to.
Really? I thought inflation was a big deal for the bond market.
It was, but Bloomberg said that now it's all about the labor market. Bond market volatility goes crazy when those non-farm payroll numbers come out, but the reaction to the CPI reports has been much calmer.
So why the change?
Bloomberg thinks it's because of President-elect Trump and his policies. Investors are more focused on how those policies will affect the labor market because that's what the Fed pays attention to. It's a good example of how politics can really shake things up in the financial world.
It definitely is.
Okay.
Before we go too deep into the bond market, let's talk about something a little closer to home overdraft fees.
Ugh, those are the worst. What's going on with those?
The Wall Street Journal said the Biden administration is changing the rules for how banks can charge overdraft fees. We don't know all the details yet, but it's something to watch out for if you've ever been hit with those annoying charges.
Yeah, for sure. It'll be interesting to see how those changes affect both consumers and the banks.
Okay, so we've covered a lot of ground today, from gold and oil to SpaceX valuations and even overdraft fees.
Oh.
So before we wrap up this whirlwind tour of financial news, let's take a step back and look at the bigger picture.
The global economy is facing a lot of challenges right now, but there are also some great opportunities. We've got central banks trying to balance inflation and growth, geopolitical tensions making everything more complicated, and investors trying to figure out what a new U.S. president will mean for their money.
Yeah, it's definitely a wild ride out there.
That's for sure. And for our listeners out there, it's so important to stay informed. Think about your financial goals and make sure you're making decisions that make sense for you and your risk tolerance.
Couldn't agree more. Now, before we wrap up this episode, I'm curious, what really stood out to you in all the news we talked about today? Anything particularly surprising or significant?
What really struck me, it's just how much uncertainty there is right now. Everywhere you look, central banks are trying to thread this needle between controlling inflation and supporting growth. And then you've got all these geopolitical tensions adding even more complexity. And on top of that, investors are trying to figure out what a new U.S. president will mean for the markets. It's a lot.
It sounds like we're trying to solve a puzzle, but we're missing some of the pieces.
In a way, yeah. But it's not all bad. There are some bright spots, too, like the NASDAQ hitting that 20,000 mark, Blackstone making that huge investment in Tokyo, even JetBlue's new approach to first class. It shows that even with all this uncertainty, there are still businesses finding ways to adapt and thrive.
That's a great point. It's not just about hunkering down and waiting for the storm to pass. There are still opportunities out there for those who are willing to look.
Exactly. It's all about recognizing both the challenges and the opportunities and making smart choices based on your own situation and goals.
Very well said. So on that note, we're going to wrap up this deep dive into today's financial headlines. We'll see you all back here tomorrow morning with more insights from the world of finance. Until then, stay curious, stay informed, and remember, knowledge is power.